Welcome to your deep dive. Today, we're going to dive into cash-secured puts,
Okay.
a strategy that might sound kind of intimidating, at first,
Yeah.
but don't worry, we'll break it down together and see
Right.
if it's something you'd maybe want to add to your toolkit.
That's right. We're using the podcast episode you provided
Okay.
as our guide
Yeah.
to give you a clear understanding of this options trading strategy.
This episode claims to be a complete guide. So
see.
let's put that to the test.
Well,
It seems to cover everything from the basic definition
Yeah.
to actually executing a trade
Mm-hmm.
and even when to avoid this strategy
Okay.
altogether.
It's interesting that the episode emphasizes the potential to acquire stocks at a discount
Right.
while also generating income,
Yeah.
which is a pretty compelling combination for any
Yes.
investor.
So let's start with the fundamental question.
Okay.
What exactly is a cash-secured put?
Imagine you're at an auction.
Right.
But instead of bidding to BUY, you're offering to BUY at a certain price
Uh-huh.
if no one else wants it.
Interesting.
That's essentially what you're doing with a cash-secured put.
Okay.
You're selling someone the right,
Mm-hmm.
but not the obligation
Okay.
to sell you 100 shares of a stock
All right.
at a specific price, the strike price,
Okay.
by a specific date,
Uh-huh.
the expiration date.
So it's like saying,
Yeah.
hey, I'm open to buying this stock at this price,
Exactly.
and I've set aside the cash to prove I'm serious.
Exactly. And that set-aside cash part is key.
Okay.
That's what makes it cash-secured.
Right.
You're committing to having enough cash in your account
Okay.
to buy those shares.
Okay.
If the person who bought your put option
Yeah.
decides to exercise their right.
The episode mentions the idea of being assigned the stock.
Right.
What does that actually mean for the investor?
Assignment happens when the stock price drops below your strike price.
Okay.
Let's say you sold a put option for stock ABC
Uh-huh.
with a strike price of $50.
Okay.
If the stock price falls to $45,
Mm-hmm.
the put buyer might decide to exercise their right to sell you those shares at $50.
Okay.
Since you sold the put,
Yeah.
you're obligated to buy them,
Interesting.
even though the market price is now lower.
So even if the stock tanks,
Yeah.
you're locked into buying it at that higher strike price.
That's why it's crucial to only use this strategy with stocks you'd genuinely be happy to own.
Okay.
Even if the price takes a dip,
Mm-hmm.
you're essentially saying,
Okay.
I'm fine buying this stock at this price.
Uh,
And if it goes lower, that's okay too,
yeah.
because I believe in the company long term.
Now, the episode specifically mentions
Right.
that cash secured puts work best
Yeah.
in neutral to slightly bullish markets.
Mm-hmm.
Why is that?
Think of it this way.
Okay.
In a neutral or slightly bullish market,
Yeah.
the stock price isn't expected to move dramatically.
Mm-hmm.
This reduces the likelihood of the stock price falling below your strike price,
Right.
which means there's less chance of being assigned and having to buy the stock at a price higher than its market value.
So you're using this strategy to potentially acquire stocks at a discount
Exactly.
during a period where you don't expect huge price swings.
It's about strategic positioning
Okay.
and taking advantage of market conditions.
Mhm.
You're not trying to time the market perfectly.
Right.
You're simply setting yourself up for potential gains
Okay.
while also mitigating some downside risk.
All right. Let's say someone is interested in actually executing a cash secured put.
Okay.
How does that process work?
First,
Yeah.
you choose a stock you'd like to own
Mm-hmm.
and decide on a strike price.
Okay.
That'll make sense for you.
Uh-huh.
Then, make sure you have enough cash in your account
Mm-hmm.
to cover the purchase of 100 shares
Mm-hmm.
per put option contract.
All right.
Lastly, you sell a put option
Okay.
for that stock with your chosen strike price
Mm-hmm.
and expiration date.
So you're essentially committing to potentially buying those shares. Right.
With the cash you've set aside.
It's crucial to have that cash ready because you don't want to find yourself in a situation where you're assigned shares
Right.
and can't afford to buy them.
Let's talk about the potential benefits.
Sure.
The episode highlights income generation
Yeah.
and acquiring stock at a discount.
Mm-hmm.
Can you elaborate on those?
Absolutely. When you sell a put option,
Okay.
you receive a premium up front.
Mm-hmm.
This premium is income
Okay.
that you get to keep,
All right.
regardless of whether the option is exercised or not.
Interesting.
It's like getting paid
Okay.
to potentially buy a stock you're interested in.
Okay. Now, I'm really intrigued.
Okay.
What does getting a stock at a discount
Yeah.
look like in a real-world example?
Let's say you're interested in owning company XYZ,
Okay.
which is currently trading at $100 per share.
Right.
You think it's a solid company, but wouldn't mind getting it at a slightly lower price?
You could sell a cash-secured put with a strike price of $90.
Okay.
If the stock price stays above $90 until the option expires, you keep the premium and don't buy the stock.
And if the price falls below $90?
If it falls below $90 and you're assigned,
Yeah.
you buy the stock at your desired price of $90,
Okay.
effectively getting a $10 discount per share.
Interesting.
Of course, you have to factor in the premium you received
Right.
to calculate your true cost basis.
Yeah.
But it's still a way to potentially lower your entry point
Okay.
for a stock you believe in.
Interesting. The episode also positions cash-secured puts as a risk management tool compared to buying the stock directly.
Yeah.
How so?
When you buy a stock outright,
Okay.
your potential losses are unlimited.
Right.
Stock price could theoretically drop to zero
Yeah.
with a cash-secured put.
Oh.
Your maximum loss is capped at the strike price,
Okay.
minus the premium you received.
All right.
You've essentially created a buffer for yourself.
Yeah. So you're participating in the potential upside
Exactly.
while also setting a limit on your potential downside.
It's a more calculated approach
Okay.
that allows you to manage your risk exposure, particularly in uncertain market conditions.
But like any strategy,
Sure.
there are downsides, right?
Yeah.
The episode mentions limited upside potential, capital lockup,
Right.
and the risk of potential losses.
Yeah.
Let's explore those a bit further after a quick break.
That's good.
Okay, so we've been talking about the potential benefits,
Right.
but now let's get into the downsides of cash-secured puts.
Okay.
What about that limited upside potential you mentioned?
Let's say you sell a cash-secured put for stock ABC with a strike price of $50,
Okay.
and it rallies to $75.
Right.
You're obligated to sell those shares at $50,
Yeah.
missing out on a potential $25 gain per share.
Wow.
That's the trade-off
Okay.
you make for receiving that upfront premium and limiting your risk.
So if I'm really bullish on a stock,
Yeah.
this might not be the best strategy.
Right. If you think a stock is going to skyrocket,
Okay.
buying this stock outright would give you more profit potential.
Right.
But of course, it also comes with greater risk
Yeah.
if the stock doesn't perform as you expect.
Now, what about this capital lockup that the episode mentions?
Sure.
That sounds a bit concerning.
It's not as scary as it sounds,
Okay.
but it is something to be mindful of.
All right.
When you sell a cash-secured put,
Yeah.
you need to have enough cash in your account to cover the potential purchase of the shares.
Right.
That cash is essentially set aside for that specific trade
Okay.
until the option expires. You can't use it for anything else during that time.
So it's like putting a down payment on a house.
Exactly.
You're committed to that investment for a while.
And that's why it's important to consider the opportunity cost
Okay.
of using this strategy. Could that cash be put to better use elsewhere in your portfolio?
Right.
Would you miss out on other investment opportunities by tying it up in a cash-secured put?
Yeah, that's a good point.
These are all important questions to ask yourself.
And of course, we have to talk about the risk of potential losses.
Right.
What's the worst case scenario here?
Sure.
Let's say the stock price completely tanks.
Imagine you sold a cash-secured put for stock XYZ with a strike price of $100,
Okay.
and the company goes bankrupt,
Oh, wow.
sending the stock price plummeting to $5.
Yikes.
You're now obligated to buy those shares at $100,
Okay.
resulting in a significant loss.
So you could really lose a lot of money with this strategy.
Of course, this is an extreme example,
Right.
but it illustrates the importance of carefully choosing stocks you're comfortable owning, even if the price drops substantially.
So it's not just about picking any stock with the potential for a discount.
Right?
It's about finding companies you believe in long term.
Exactly.
Yeah.
You're not just trading options.
Okay.
You're making an investment decision. You need to be comfortable with the underlying asset and have a thesis for why you believe it's a good investment.
This episode lists some specific requirements for using this strategy.
Okay.
What should investors know before diving in?
First and foremost,
Yeah.
you need to have enough cash in your brokerage account to buy the shares if assigned.
Okay.
This is non-negotiable.
Got it.
You also need to have options trading approval
Okay.
from your brokerage.
Mm-hmm.
Most brokerages have an application process
Right.
to assess your suitability for options trading.
That makes sense. Options trading can be a bit more complex.
Yeah.
than buying and selling stocks.
Yeah.
So it's important to make sure you understand the risks involved.
Absolutely.
Right.
And beyond the technical requirements,
Okay.
the episode emphasizes the importance of selecting fundamentally strong companies
Right.
that align with your overall investment goals.
Okay.
It's not just about picking any stock
Right.
with the potential for a discount.
Mm-hmm.
You want to be comfortable owning the underlying asset.
Okay. Let's delve into the risks associated with cash-secured puts.
Sure.
The episode specifically mentions assignment risk,
Yeah.
market volatility,
Mm-hmm.
and opportunity cost.
Okay.
Can you unpack those for us?
Assignment risk is the possibility of being assigned shares.
Okay.
If the stock price falls below your strike price,
Mm-hmm.
it's the inherent risk you take
Right.
when selling a put option.
So it's not just a hypothetical risk.
Right.
It could actually happen.
You need to be prepared for that possibility
Right.
and make sure you're okay with owning those shares at that price.
All right.
Market volatility refers to the potential for sharp price swings,
Mm-hmm.
which can impact the value of your put option
Okay.
and increase your chances of being assigned.
I see.
If a stock is highly volatile,
Yeah.
it might not be the best candidate for a cash-secured put.
And opportunity cost is all about what else you could be doing with your money
Exactly.
if it wasn't tied up in this strategy.
What if that cash could be invested in a different asset
Right.
that generates higher returns?
Yeah. Okay.
Or what if you need that cash
Yeah.
for an unexpected expense?
Yeah. Good point.
These are all things to consider
Mm-hmm.
when evaluating the opportunity cost of a cash-secured put.
The episode also outlines situations where
Mhm.
it might be best not to use cash-secured puts.
Okay.
When should investors steer clear of this strategy?
Think of a volatile stock like a roller coaster.
Okay.
It can be thrilling,
Yeah.
but it's also unpredictable.
Right.
Those wild price swings could turn a cash-secured put into a risky bet
Yeah.
because you never know which direction the stock is going to move next.
So sticking with more stable and predictable stocks
Yeah.
is generally a better approach?
It often is,
Okay.
especially when you're first starting out with options trading.
Mm-hmm.
The episode also emphasizes the importance
Okay.
of being genuinely comfortable owning the stock
Right.
at the chosen strike price.
Yeah.
If you're not confident in the underlying company,
Oh, yeah.
it's best to avoid this strategy altogether. You don't want to be forced to buy shares
Right.
in a company you don't believe in.
And there's the cash flow flexibility element, too.
Right. If you anticipate needing access to your cash in the near future,
Okay.
tying it up in a cash-secured put might not be the best move.
Yeah, right.
You want to make sure you have enough liquidity
Mm-hmm.
to meet your financial obligations.
This is a lot of great info.
Yeah.
So we've got the basics, execution benefits,
Yep.
and risks down.
Okay.
What else do we need to cover?
The episode wraps up by mentioning a few other important factors to consider.
Okay.
Things like tax implications,
Mm-hmm.
choosing the right strike price,
Okay.
and selecting an appropriate expiration date.
Let's break those down one by one.
Sure.
Starting with taxes.
Okay.
I know options trading has its own set of tax rules.
It does. The premiums you receive from selling put options
Mm-hmm.
are typically taxed as ordinary income,
Okay.
just like your salary or wages.
So it's taxed like regular income.
Right.
Got it.
And if you're assigned shares
Yeah.
and later sell them for a profit,
Mm-hmm.
you'll have to pay capital gains taxes on those profits,
Okay.
just like you would with any stock sale.
So it's not a way to completely avoid taxes,
Right.
but it's important to be aware of the potential tax consequences.
Definitely. Now, when it comes to choosing the right strike price,
Yeah. Okay.
it's all about finding the right balance
Mm-hmm.
between risk and reward.
How so?
A lower strike price
Yeah.
offers a larger potential discount if you're assigned shares,
Right.
but also increases your chances of being assigned.
Okay.
A higher strike price
Mm-hmm.
reduces your assignment risk,
Right.
but also limits your potential profit.
So there's always a trade-off
Exactly.
you need to make
Mhm.
based on your risk tolerance and investment goals.
Yeah, it sounds like there's no right or wrong answer.
Yeah.
It depends on your individual circumstances
Yeah.
and how you approach risk,
And then there's the expiration date to consider.
right? Shorter expirations generate more frequent income
Okay.
because you're constantly selling new options,
Right.
but also require more active management
I see.
because you're making more frequent trading decisions.
So if I choose a shorter expiration date,
Yeah.
I need to be prepared to spend more time monitoring my positions
Right.
and making adjustments as needed.
It's more hands-on.
Got it.
Longer expirations. Tie up your capital for extended periods,
Hmm.
but offer more time for the stock price to move in your favor.
Interesting.
It's a trade-off
Okay.
between frequency and duration.
So it's important to align your expiration choices
Right.
with your overall investment strategy.
Exactly.
If I'm a long-term investor,
Yeah.
I might be more comfortable with longer expirations, even if it means less frequent income.
That's a great point. It all comes back to understanding
Right.
your own investing style and goals.
The episode also stresses the importance of staying updated on market news and earnings reports. For the stocks you're considering, how does that tie into the cash-secured put strategy?
Think of it this way.
Okay.
Earnings reports can significantly impact stock prices. If a company announces better than expected earnings,
Yeah.
its stock price is likely to rise,
Right.
which would decrease your chances of being assigned on a cash-secured put.
And if the earnings report is bad?
If the earnings report is disappointing,
Yeah.
the stock price might drop,
Okay.
increasing your chances of being assigned.
So staying informed about these events can help you make more informed trading decisions.
Exactly.
You might decide to adjust your strike price
Yeah.
or expiration date based on the latest news and analysis.
Right. It's all about being informed and adaptable.
Okay, so we've covered a ton of information about cash-secured puts. What stands out to you as the most important takeaway for our listener?
What's fascinating to me is how this strategy can be tailored
Okay.
to an individual investor's goals and risk tolerance. It's not a one-size-fits-all approach. The choice of stock,
Yeah.
strike price,
Right.
and expiration date all play a crucial role in shaping the outcome.
It sounds like the key is to really understand the mechanics of the strategy.
Exactly.
And how those different variables can impact your potential profits and losses.
And remember, this deep dive is just a starting point.
Right.
There's a whole world of resources available. If you want to explore cash-secured puts, further books, articles, online courses,
Yeah.
the possibilities are endless.
Absolutely. And don't be afraid to reach out to financial advisors or experienced options traders to get personalized guidance. Knowledge is key.
Absolutely.
And continuous learning is essential in the ever-evolving world of finance.
One thing that wasn't explicitly mentioned in the episode, but I think is worth highlighting, is the psychological aspect of options trading.
That's a fantastic point.
Are you comfortable with the potential for both gains and losses? Can you handle the pressure of making decisions in a dynamic market environment?
Understanding your own risk tolerance
Absolutely.
and emotional resilience is crucial. This deep dive has given you a solid foundation of knowledge.
Right.
But the real learning comes from experience and self-reflection.
So, as you continue your journey in exploring cash-secured puts, remember to approach it with a balanced mindset, a commitment to continuous learning, and a healthy dose of caution.
Well said. This has been a truly insightful deep dive into cash-secured puts.
It has.
We hope you've gained a clearer understanding of this powerful yet complex strategy.
Absolutely.
Remember, knowledge is power.
Yes.
And with careful planning and informed decision-making, you can navigate the world of options trading with confidence. Happy investing. So we've covered a lot of ground here, from the nuts and bolts of what a cash-secured put is to the potential benefits and risks, and even when it might be better to just steer clear.
What stands out to me is how this strategy isn't just about blindly selling put options. It requires a thoughtful approach. You're essentially making informed decisions about specific companies and setting yourself up to potentially acquire shares at a price you're comfortable with.
It's like being a savvy shopper, but for stocks, you're looking for deals and setting your own terms.
Exactly. It's about being proactive and strategic rather than just reacting to market movements.
This deep dive has given our listener a fantastic overview, but I'm sure there are still some lingering questions. Where would you suggest someone go to learn more about cash-secured puts and actually start putting this knowledge into practice?
There are tons of great resources out there. Books like Options is a Strategic Investment by Lawrence McMillan are considered classics, and websites like Investopedia offer comprehensive guides and tutorials on options trading. Plus, many brokerages have their own educational platforms with articles, videos, and even simulated trading tools.
Those simulated trading tools are a great way to test out different strategies without risking real money, kind of like a flight simulator for options traders.
Right. It gives you a chance to get comfortable with the mechanics of trading and see how different scenarios might play out.
And don't forget about the power of community. There are online forums and social media groups dedicated to options trading where you can connect with other investors, share ideas, and learn from each other's experiences.
Absolutely. Learning from others who have been there and done that can be incredibly valuable. Plus, it's always helpful to have a support system as you navigate the world of investing, especially with something as nuanced as options trading.
The episode we've been discussing touched on the importance of staying updated on market news and company earnings, but I think it's worth emphasizing how crucial that is for options traders.
It's absolutely essential. Options prices are constantly fluctuating based on market sentiment and expectations. A sudden news announcement or an unexpected earnings report can drastically change the value of your options positions.
So it's not a set it and forget it kind of strategy. You need to be actively monitoring your positions and making adjustments as needed.
Exactly. It's like sailing a boat.
Yeah.
You need to constantly adjust your sails based on the wind and the currents, otherwise you'll end up off course.
One thing that wasn't explicitly mentioned in the episode, but I think is crucial for anyone considering options trading, is the psychological aspect. It's not just about crunching numbers and understanding the technicalities. It's also about managing your emotions and making rational decisions under pressure.
That's such a great point. Options trading can be emotionally charged, especially when you're dealing with real money. You need to be able to stay calm and focused, even when the market is moving against you.
It's like playing poker. You can't let your emotions get the best of you. You need to stick to your strategy and make calculated decisions based on the odds and your risk tolerance.
Right. And that takes practice and self-awareness. It's important to understand your own emotional triggers and develop coping mechanisms for dealing with stress and uncertainty.
Well said. It sounds like the key takeaway here is that cash-secured puts can be a powerful tool for investors who are willing to put in the time and effort to learn the strategy, manage their risks, and stay disciplined.
Absolutely. It's not a get-rich-quick scheme. It's a thoughtful approach to investing that requires knowledge, patience, and a bit of a risk-taking spirit.
This deep dive has given our listener a solid foundation to build upon. Hopefully they now feel empowered to explore this strategy further and see if it aligns with their investment goals and personality.
I hope so. It's been a pleasure breaking down this complex topic and shedding some light on the potential benefits and risks of cash-secured puts.
Thanks for joining us on this deep dive into the world of options trading. Remember, knowledge is power, and with careful planning and informed decision-making, you can navigate the world of investing with confidence, happy investing.
All right, so we're back for another deep dive, and today we're looking at something pretty interesting. We got a podcast, and this one focuses on stock and options trading strategies.
Interesting.
Yeah, so we're going to be taking a look at the sponsors behind this podcast.
Okay, sounds good.
So from what I've seen, there were two sponsors that are mentioned pretty consistently throughout the episodes.
Right.
The first one's RDSP Investments.
Okay.
And the second is soundymax.com.
That's interesting.
Yeah. What do you make of that?
Well, I mean, the RDSP Investments one makes sense.
Right.
Target audience, people interested in finance.
Exactly.
Potential investors.
Yep.
Makes sense to advertise there, but the SoundyMax one, that's a bit curious.
Yeah, soundymax.com.
Yeah, they're all about microphones from what I could gather.
Yeah, so what's the connection?
Right. It seems a little out of place at first glance, but I think it's actually quite clever.
Okay.
When you think about it, who are the people that are listening to podcasts? A lot of them are probably thinking about creating their own content.
Right.
Whether that's a podcast, a YouTube channel, or anything that needs good audio. And SoundyMax is tapping into that market.
Yeah.
Directly reaching their target audience.
That's true. They're going right to the source.
Exactly.
Yeah, that's a good point. And it's not just about the sponsorships themselves. This podcast really leans into that whole interactive side of things, too.
Oh, yeah, for sure.
Like they're constantly asking listeners to subscribe, leave comments, even suggest future topics they want to hear about.
Which is smart.
Yeah. What do you think about that approach?
Oh, I think it's key for any podcast that wants to grow.
Okay.
Build that sense of community, understand what the audience actually wants to hear,
right.
Keep them coming back for more.
Right. And especially for a finance-focused podcast, I would imagine that direct feedback is probably pretty valuable.
Oh, absolutely. Things are constantly changing.
Yeah, for sure.
Strategies need to adapt. So having that direct line to the audience.
That's gold.
So it seems like there are some pretty interesting benefits for all sides here.
Yeah, definitely.
You've got the podcast itself, getting that financial support.
Right.
The sponsors are getting that exposure to such a targeted audience. And then the listeners are getting engaging content and a platform to actually interact and share their thoughts.
It's a win-win.
It really is. And it makes you think about the relationship between content creators, sponsors, and the audience.
Absolutely.
So for everyone listening out there, I want to leave you with this thought. How much does the presence of a sponsor influence your perception of a podcast?
Good question.
Yeah, it's something to consider as we all navigate this constantly expanding world of online content.
Lots to think about.
All right, that's going to do it for this deep dive.
Well,
Thanks for joining us.
thanks, everyone.
We'll see you next time.
See ya.